Brian, here is your reminder from Natalie. Reply to the coach.
Okay, I believe we are live. I think we are. Testing, testing. How's it sound? Man. Three ads, come on. Okay. How do we sound? Three ads, come on. I feel like we sound good. Let me know in the chat, please, if something is not quite right. Just make sure I have all of my tabs in order, and then we will get started. Okay. Hey, Hokage, I hope you're doing well. Thanks for joining me. Sounds okay. That's good. Okay. All right, let's get this show on the road. The question is, why in the world am I looking at a company that's trading for $1.35? The answer is, and I've been talking about this a lot lately, and I'm not going to stop talking about it because this is a cheat code. It feels like a cheat code to finding value stocks. Small companies, low volume. This is the basket of stocks where people are not looking. And that is the best way to find value companies, because whenever you're trying to compete with the entire world, whenever the entire world is looking at stocks and everybody, the multi-billion-dollar hedge funds, analysts, they're looking for information, and as soon as the information comes out, it goes to the people in the know first. The stock price reacts. It is so difficult to find truly deep undervalued companies when you are looking at, let's just say, the Magnificent Seven, for instance. Everybody in the world is scrutinizing these companies. So what I've started doing is I have started looking at the ones that nobody's looking at. So I did a screener right here that actually only returned one stock, just one, out of thousands of companies that could have that are in the stock market. This screener returned only one. So what did I put in this stock screener? I wanted volume, average volume under 100,000. I believe that's what I picked, right? Yes, under 100,000. Market cap under 10 billion. So it has to be mid cap, medium cap, or less. Price to book ratio under 2. Revenue growth over the next 5 years, I wanted it to be at least 5% projected. So companies where analysts think that the company is going to be at least growing. Now, this is a little bit contradictory, and this is really the reason why only one company showed up in this filter, because if I'm looking for small companies, and there's not many analysts that are covering them. So that does present a little bit of an issue, because I really like to lean on some analyst projections for future revenue guidance. So if I were to get rid of this filter, then about 60 companies would show up. So this is really what's doing it. Operating income growth over the last 5 years, greater than 5%. I want to see the company growing. And then debt to equity ratio less than 2. So Heritage Global Incorporated. This is the company that came up. And this company is insanely undervalued. And I'm going to get into why. Exactly why do I think this company is deep value? Hokage, FYI, I was checking some tickers from your list. Google, PLAB, AGI, HG, HCA, BTI, GenMab, Capital One Finance, Region, all at least 40% up so far year to date, and as high as 101%. Some of these tickers we doubled down. Yes, I saw that. I was looking at the portfolio just before I went live, actually, and that is nice to see. Especially, PLAB went up quite a bit recently. It surpassed Google. Let me pull up my portfolio. Thank you for bringing that up, Hokage. That's maybe now's a good time to, PLAB went kaboom today. And I haven't looked into what's going on with that company. So unfortunately, I don't know. But let me pull up the portfolio. Now's a good time. So, okay. Right now, we got $6,561 in the portfolio. This is the YouTube public portfolio series where I invest in a different company every week. This week, unfortunately, the company that I have found that is insanely undervalued is not available for trade on M1 Finance. So it's going to go, I'm investing in it on my non-public YouTube portfolio. So this has happened a couple times now where the companies that I want to invest in, they're not supported. So I'm strongly considering changing my public portfolio from M1 to something else, like maybe Charles Schwab. So I'm kind of debating that right now. I kind of like the way M1 shows it. So aesthetically, I like M1, but the fact that I can't invest in some of these companies publicly because I want to keep my public YouTube portfolio all in one place, makes it difficult. Oh, they beat. Okay, so Hokage says they beat earnings and profit increased. We might have to do another intrinsic value analysis on it. Yes, that is not a bad idea. I probably should do some analysis since it has gone up so much. And here it is right here, up 131% year to date. So if I look at the portfolio performance, let's pull that up. How are we doing relative to the market? Go over here. This is another thing I really like about M1 is it tracks my performance against other indices. So we can see at the beginning, whenever I didn't have very many companies in the portfolio, because remember, we invest in a new company every week. It was very volatile at first. And as we have upped it to 42 companies now, I believe we have been kind of tracking along with the S&P 500 pretty closely. But the goal is to beat the S&P 500 long term. And so far, when I add the S&P 500, we are doing that so far. So year to date, over the last year, 11 and a half months, we are up 23.55. The S&P is up 18.35. So we are edging out the S&P 500 right now. So that is nice. But yeah, good point, Hokage. I should revisit PLAB because it has popped so much lately. That's a great idea. But let's get back to this company right here, HG. Why in the world am I looking at this company? So, all right, market cap, only $44 million. This is truly a small company. Price to book ratio, this one I love. The stock price divided by the book value of the company is 0.65. That means so if this company was to say liquidate and sell all their assets and just return that money to shareholders, the money for just their assets would be worth more than their stock price. Normally companies trade on a much higher price to book ratio. They have revenue growth projected, strong growth in operating income, and debt to equity is minuscule. They virtually have zero debt. So their cash, and let's just actually pull up their financials right now. So in terms of risk, this is one of the things I like to look at. Let's go to their balance sheet. They have $19.5 million sitting there in cash right now. Their total debt, they have zero short-term debt, long-term debt. They only have $4.1 million in long-term debt. They have $19.4 million in cash. So this company is not going out of business because they have a problem paying their debt. They've got no debt issues at all. So I love to see zero debt. When I look at their interest expense, it's zero. They're not paying any interest. So it's in a really good spot in terms of risk levels, in terms of their equity. Let's look at that. So the market cap, this is if all of the publicly traded shares were to sell at once, this company would be worth $46.5 million. They revenue for like basically 50 million over the trailing 12 months, I believe. So, okay. The company's value on the stock market, 46 million. Financials, balance sheet. Total assets, 86 million. They've got some liabilities, 13. They've got 20 million in liabilities. So the shareholder equity is $66 million, even though it's only trading for, what did we say, 46 and a half. So right off the bat, this appears to be a value company, and a lot of people will stop there. And that's what the traditional value metric is price to book. But on this channel, I do a discounted future free cash flow analysis. That is where I'm looking. What is the future projected cash flows? Now, there are some forecasts on stockanalysis.com. The average analyst opinion is that it should be $4 per share. That would be a massive upside, which hopefully they are right. But let's look at the revenue projection. Revenue forecast. Okay, revenue growth. So the average analyst believes 16% revenue growth in 2025, 5% revenue growth in 2026, and then 3 to 5% going forward. Now, on Charles Schwab, I also pulled up their stock report here, LSEG Stock Report Plus. This website, or this analysis firm, they give it a buy rating. They've got 4 analysts. Where's the projected price? Well, anyway, let's just scroll down to the revenue projections. So on this analysis as well, 3 analysts in 2025, they're saying 13.8, and then over 2 years, 19%. So multiple analysts are projecting revenue growth. So that looks good to me. Now, there's not a ton of analysts. This is probably a pretty high risk. It could be very lumpy, especially when I look at their past revenue performance. It is quite lumpy. So I'm going to be taking this into account. So overall, if I go back 10 years, they have steadily grown on average over the last 10 years. However, there are some years where they increase quite a bit and some years where they decrease quite a bit. So right here, this year, 2015, they decreased 12.7% from 2014. Then they went up 36%. Then they went down 15%. They went up 17%. Here they decreased by 25%. And then here it went up by 80%. So very lumpy revenue growth. In terms of their profitability, let's go to their margins. Gross margins, pretty consistently between, pretty lumpy as well. Gross margins are pretty lumpy. Free cash flow margins are up and down. So there's a lot of lumpiness here that I need to contend with. Now, all of that being said, the free cash flow analysis is still staggering. So let's look at what I came up with. So free cash flow margin, I am assuming 12.5%. Their average over the last 5 years is 14%. Let me go to the breakdown. So on the breakdown here, I'm not giving them any credit for R&D spend. I'm giving them 0 credit for capital expenditure spend, giving them 0 credit for acquisitions, and I'm counting virtually all of their stock-based compensation against their average. So that's where I'm getting 12.5, even though their average over the last 5 years is 14. I have taken some of that credit away. And we can see here in 2020, they did a very good job, and then they did not so well in 2021. So these are kind of canceling themselves out. And then here has been their, they've been kind of tracking along the average. So 12.5%, that's what I'm going with. Going with 12.5%. In terms of future revenue growth, I'm going with 0%. I decided to just put in, let's say they're just lumpy going forward. They're up and down, but they do not grow, even though over the last 10 years, they have their through line has been positive. I'm putting in 0 growth. 0 revenue growth. They're just maintaining the lower end of their free cash flow margin. Based on that assumption, I'm seeing a 71% upside in terms of discounted future free cash flow. That's on top of an 8.25% return every year. So the market is giving this company basically a death sentence. Like the market is saying this company is going to shrink. So if I put in -3, -3, there's still, so if this company reduces their revenue by 3% every single year forever, they're still They're still undervalued right now. So the next thing I want to look at is how confident am I that they will be able to at least exceed, what is it, -5? What do I have to put in here to make it fair price? Basically -5. What do I have? Do I believe that they are going to exceed losing -5% revenue forever? They're basically not, as long as this company is not going out of business, as long as they're just not shrinking going forward, then this company is going to return a lot of money. Now, why is it so undervalued? It's a tough question to answer with a company like this. It has such low volume. It's small. It doesn't take much. It does not take much buying or selling to move the stock price. So it has pretty wide swings over the last 5 years. The bottom here is about $1. It goes up to $3.60. It goes back down to $1. I'm not big on technical analysis, but somebody who is big on technical analysis might say that it is hitting a long-term support. Maybe that's true. That doesn't concern me. I am more so looking at the future in terms of free cash flow. So the question I want to answer mainly is, how confident can I be in this future revenue? So going to Morningstar. Morningstar has provided the transcript for their latest earnings call, November 6th, which I found to be very, very interesting. So let's look at this a little bit. Ross Dove, CEO, I believe. Okay. Without overemphasizing the future outlook on the financial side, I completely skipped a step. What does this company do? Oh my gosh, I need to talk about, what does this company do? Heritage Global, leader in valuing and monetizing industrial and financial assets. What does this company do? Heritage Global values and monetizes industrial and financial assets by providing acquisitions, disposition, valuation, and lending services for surplus and distressed assets. Okay? Industrial assets and financial assets. Specialties consist of acting as an advisor, in addition to acquiring or brokering surplus industrial machinery, turnkey manufacturing of facilities, industrial inventories, real estate, account receivable portfolios. So let's look at their breakdown here. So for industrials, they do auctions. They auction and they liquidate assets in 25 plus industrial sectors. They do valuations. They also refurbish and recover distressed or recovery, refurbishment, and resale of assets in the life sciences industry. On the financial side, they brokerage, charge off of non-performing financial assets, and specialty lending, flexible funding structures for all asset classes. So distressed assets, if there's a bunch of distressed assets, this company's got business. Okay. Basically, that's what they do. Okay. They improve balance sheet, strengthen free cash flow. Oh, wait, sorry. This is what's next for them. Anyway, that's what they do. They're looking to auction distressed assets, refurbish, etc. If I go back into their timeline, so they did the auctions for X whenever Twitter sold, 2023. They handled a bunch of those auctions. Let's see, NASDAQ, congratulations. Sorry. Halliburton, they did Halliburton auctions. Let's keep going up. They uplisted to the NASDAQ in 2020. So this company was trading over the counter until 2020. Now it's on a major exchange. What else did they do? More auctions here. Red Hook Brewery auction. Par Pharma campus auction. They do lots of auctions. Okay. So if there are assets in distress that need to be auctioned off or assets that need to be refurbished, this company comes in and they handle it. Okay. And they go back. They have a long history. I was reading through these. 1980s. What's their first auction? 1937. They were founded. Beale Air Force Base auction. So they go back a long ways. Back to this right here. Okay. Without overemphasizing the future outlook, on the financial side, regional banks continue to report an increase in distressed assets, and every indicator says asset flow is on the rise. On the industrial side, a continued push towards lean manufacturing and a prediction of more consolidation over time also bodes well for increased asset flow. That's what they're looking for, asset flow. We have built our balance sheet and staffing and systems very prepared to garner market share as opportunities arise. Further, I am excited to report after a 2-year phased approach to our merger and acquisitions, we are past fine-tuning our strategy and they are now in the tactical execution. So they have, according to the CEO, a bright outlook where all the indicators they're seeing more business on the horizon. They are excited to expand through mergers and acquisitions. And if I scroll down just a bit further where they talk about share repurchases, one moment. Okay. Right here. So he said the question was about share buybacks. So in response, they're saying, if we thought these merger and acquisition transactions were further away, they're more in the distance, then we would put greater emphasis on buying back the stock. Yes, we think the stock is way undervalued, but at the same time, we think that these acquisitions are really going to help grow the company. Showing growth in the company is the most significant, most important thing we can do. However, we did authorize 7.5 million and are prepared to flip the switch, so to speak, and start buying stock back. Excuse me. As of right now, there's heightened emphasis on getting some of these things that are right in front of us done first. So they are on board with buying back stock. They have approved 7.5 million over 3 years. However, they're looking to spend their cash right now on some key mergers and acquisitions. So let's just go back to their financials really quick. On their cash flow statement, we can see how much money they've been putting into buying back shares. So right down here, repurchase of stock. So over the last 12 months, they have bought back 3.88 million. In 2024, they bought back 2.3 million, and it has increased steadily since 2020. So they've been increasing their share buybacks. 7 million over 3 years, average out, it's like 2.5. There's nothing saying that they will wait all 3 years to buy back the stock, but they would have to get a new share repurchase program approved. So we could see we could see up to 7.5 million in the coming year of share buybacks, depending on how their mergers and acquisitions go. In terms of yield, what yield does that equate to in terms of, like, if they were just to pay a dividend with that money? Oops, financials. So on the income statement, we can see their shares outstanding. So over the trailing 12 months, they have reduced their shares outstanding by 2.67%. So in terms of a dividend yield, that would translate to about 2.67%. We'll see if they continue on that pace going forward. But it looks like they have some big it looks like they have some big acquisitions that they have planned in the near future. So what am I looking for in this company? Yes, I'm going to be investing a small amount now. I'm going to be looking into the future to see what kind of mergers and acquisitions they're talking about. Their most recent acquisition, if we go back to their, where was it? Dang it. Oh, company overview. Okay. They had a recent acquisition, which does, as far as I can tell, it seems to synergize. I'm hoping to see more synergistic acquisitions. Where is it? What am I looking for? Legacy of asset solutions. Sorry, where is it? The synergy between these two business units defined the legacy of asset solutions. Hold on. Oh, here we go. Heritage Global Partners acquires American Laboratory Trading, one of the largest suppliers of premium refurbished lab equipment in North America. So as far as I can tell, this synergizes very well, because if they are auctioning distressed assets, especially industrial assets, if they have lab equipment that needs to be refurbished, it makes sense that they would, it makes sense that they would acquire a company that specializes in that. It's like is in their wheelhouse. So I like acquisitions like this. I'm assuming, since this guy is making a big deal about mergers and acquisitions that he's excited about in the near future, I'm going to be looking to see how that pans out. That's going to be a big indicator for me. I like to see, when a CEO or a chief financial officer, if they are making big claims in their in the earnings call transcripts, that's one of the things I like to check them on. Like, do they say what they're going to do, and then do they do it successfully? That's a big thing. So this company, I can see how it would be. They don't give future guidance internally on revenue. I can see that would be difficult because they are dependent on, like he says, asset flow. So it can be unpredictable. From what I'm hearing, he's projecting an interesting future. When he talks about their performance so far, let's actually go to that really quick. So for 2024, he basically talked about attacking a bunch of smaller projects. Let's see. Where did he discuss that? Okay. For many reasons, we were challenged and succeeded through a wait-and-see economy for transactions. We made a profit more like a journeyman fighter, going all 12 rounds because we kept swinging. With many large transactions slowed in a wait-and-see time with interest rates and tariff considerations and overall less ability to execute large transactions. There were no big needle movers. Opportunities we performed were at a high conversion rate on transactions. That did occur, albeit a lot of smaller ones. So they basically were able to execute on many smaller transactions to continue to be profitable, but they are saying they're seeing good future outlook. Just to say this one more time, without overemphasizing the future outlook, on the financial side, regional banks continue to report an increase in distressed assets. So there's going to be a lot of opportunities going forward. I think this is a good time to invest in this company, considering nothing is concrete yet. On a company like this, when things do become concrete, it doesn't take much money flowing in to push the stock price up. Now, one concern that someone might have investing in a small cap, low volume company like this, she might say, Brian, this company, if I go to their stock chart over the last 5 years, this company's been growing its revenue, like you said, for the last 10 years. And yet when I look at the last 5, I'm seeing up, down, up, down, up, down. Like, why would I invest in this company? So all I can say is my approach to value investing is I find companies that are trading below what their future projected discounted free cash flow would suggest. On average, the price of the share is going to intersect the fair value at some point. It may intersect it and go higher. It may intersect it and go lower, but eventually they tend to intersect. Now, that's not to say that I'm setting my intrinsic value a little over $2 per share right now. That's not to say that intrinsic value can drop in the future. As more information comes out, I may find that Heritage Global is not getting any more big projects. And then that intrinsic value would drop, and then it might intercept the share price in that way. And that would be unfortunate. That is why we find as many strong opportunities as we can. I am looking to build a portfolio of small cap, low volume stocks, all of them as deep value as I can find. That way, if one or two don't pan out, it's not going to hurt the portfolio too much. And ideally, the winners will be significant enough, because if these companies are truly as undervalued as they appear, I mean, this is assuming 5% dropping revenue, still 12% upside on this company, on top of an 8% return. I mean, if this company, let's just assume it does what the analysts believe. Let's assume that it averages 5% revenue growth over the next 5 years. And then I'll assume a 2% perpetual growth rate, which is quite conservative, and a 3% growth rate for years 6 through 10. If that's my assumption, then I'm seeing a 154% upside on top of my 8% gains. So this is a company that has such a significant upside, even though it has some risks. Yes, it's It's unpredictable. It is uncertain, and it's small and low volume, but these are the kind of companies I'm looking for. So, Okaje, if you're still around, I'm curious what you think about this one. It's a little bit different than the companies that I have invested in so far. I guess in terms of share price, this company it's tiny. If you don't have any questions about it, then I will move on to because I have to invest. I got $100 in my YouTube public portfolio. I got to invest $100 every week. I'm looking to double down on a company this week instead of investing in a new one. The new one I brought up, HGBL, unfortunately not offered on M1, but I will be investing. The company I'm doubling down on is Uber Technologies. This company has dropped a bit lately. It's down a bit since I invested. And this is a company that is the polar opposite of the company I just looked at. This company is heavily scrutinized. It does have some risk associated with it right now, though. There's a lot of unknown with this company. A lot of people are speculating that autonomous vehicles are going to be an issue for Uber. Now, there are a couple different possibilities that are laid out in, wait, where is it? Oh, yes. This is the Morningstar Equity Analysis Report right here. This is what they have to say about Uber. So Morningstar, on this report, it says it's 3-star. It says it's overvalued. However, this is outdated. The share price is outdated. They're giving a fair value estimate of 93 on this report. However, as we know, the stock price we just saw is 84. So it is undervalued according to Morningstar. Well, at least, on this report. They have a narrow economic moat. The economic moat that they do have is they have such a huge, they have such a massive pool of customers. So I'm trying to remember what this one's called. This economic moat is called, well, I'm sure they talk about it actually. Let me just scroll down to the moat here. Economic moat. Here we go. Uber operates as a dynamic marketplace that we believe warrants a narrow moat rating based on primarily network effects. There we go. Network. So they have such a broad network. So put yourself in the customer's shoes. If I want a ride, the first place I'm going to look is Uber because there are so many drivers. They're the first mover. They're everywhere. Like I'm most likely to get a reliable ride from Uber. So as a customer, that's going to be my first look. If I'm looking to be a driver for Uber, then if I'm looking to be a driver and I'm thinking about the different providers, well, Uber has the most volume. Like it gets the most business. If I'm going to be a driver, I'm going to sign up to drive for Uber. So this network effect is kind of, it builds on itself. There's a flywheel effect. So this is the moat that Uber has. Now, that doesn't mean it's without its competition. It has competition, but it was the first mover. It has the biggest network. That gives it a narrow moat. So why do I want to double down on this company? So in my humble opinion, Uber is a very strong company. Let's pull up Uber really quick. So initially, we're seeing negative numbers down here. So that does not look good. However, and actually, I've already pasted in Uber's the forecast, the revenue forecast. So analysts put Uber at a strong buy, interestingly. If I scroll down to the revenue projections, revenue growth is massive. 20, 15, 14, 11, massive revenue growth. Morningstar believes roughly 15% revenue growth for the next 5 years. We expect to grow at least 15% annually until 2032. The firm faces ride-hailing competition from players such as Lyft, but Uber is clearly the superior network. Okay. Uber also faces competition from scaling AV platforms like Waymo and Tesla. So they have their competition, although as more of these autonomous vehicle companies start rising up, my thought is that Uber would be wise to partner with these companies. The companies benefit because they get to have access to Uber's massive network. That's their moat. Their network is massive, so it makes sense to partner. Uber benefits because they no longer have to pay a human. So Uber becomes more profitable. The companies have access to more riders, right? This is a synergistic partnership that I believe is likely with Uber. This would increase their profitability going forward, and making it cheaper for people who want rides will probably also increase their revenue. So I think there's going to be some very good, strong partnerships in the future, but that is uncertain. So we're not putting the whole portfolio into Uber. It is a small part of the portfolio. Okay. I know I stress that a lot, but I find it very important to remind people that when you're investing, you're dealing with uncertainty. There's always going to be uncertainty. And so even if you make the best decision, it may not turn out well. And in the future, if it doesn't turn out well, it doesn't mean that you made a bad decision in the past. It just meant that you got an unfortunate roll of the dice in terms of uncertainty. And the best way to deal with that is through a little bit of diversification. So, okay. What kind of free cash flow margin is Uber looking at? So Uber has recently become profitable. As their volume has increased since 2020, they have popped up in the free cash flow margin of about 11.8. I do give them a little bit of credit though for R&D, a little bit of credit for, CapEx, 12.5% free cash flow margin. If I give them credit for 12.5, and let's say Morningstar is correct, 15% revenue growth over the next 5 years, 3% growth, perpetual growth rate. We'll do 8%. We'll say it reduces in years 6 through 10. We'll say the revenue growth slows down. It may not. But given that set of scenarios, the Morningstar price would be $98 per share. That represents a 17% upside. The analyst revenue projections give me a range of losing 43% to gaining 63%. Now, I believe as autonomous vehicles come online, we're going to see some increases in free cash flow margin. So that's building in 0.5% increase per year. That's where Uber has been trending anyway. They've been trending up in free cash flow margin. So I'm going to give them credit for that. That bumps me up to 39% upside on top of my 8.25%. So finding a company like Uber that has a moat, it is incredibly profitable. It's a massive company, and it has Uber, not worldwide yet. Uber is not everywhere. So it has lots of room to grow. It's not in every single market. It's maybe you could say it has saturated the US market, but that's going to change. That's going to change. Recently, or going back, we had a lot of red flags with Uber historically. High percentage of selling, general, and administrative costs, high R&D, high interest as a percentage of income. But in 2024, as they are becoming more and more profitable, as they are spreading out, they are dropping off some of these red flags. And so now for the first time this year, I am more confident investing in Uber from a red flag perspective. There's a significant upside potential with Uber. In the past, lots of risk. Now, not as much risk. CapEx is low compared to earnings. Depreciation is low compared to earnings. Plenty of liquidity with their adjusted current ratio. A lot of these were in the red previously. So I think Uber is a very strong company and a pretty safe company to double down on in the portfolio. And one moment. I need to get this opened back up. Let me get Uber pulled up. Okay. All right. Where is Uber on this list? I got to go all the way to the bottom. Right here. Currently down about 9.5% from when I bought it. However, I think this is a good company. In terms of free cash flow, in terms of potential, I think Uber looks really good. And I love investing in a company that has a moat. So this week, we are buying $100 worth of Uber. Boom. Okay. It's done. Now, Hokage correctly pointed out that we have significant gains in one particular company. Plab. This was a company that we doubled down on too, as I think you also pointed out, Hokage. So Plab, how does Plab look today? That's the next question I want to answer. Let's do a quick free cash flow analysis. Let's see. Plab. Okay. Overview. 45%. Jeez. Boom. Okay, now I gotta say, with Plab, you know, the analysis. Oh, sorry, Hokage, are you buying HGBL2 or just Uber? I am buying HGBL. However, I cannot buy it on M1 Finance. I'm going to be investing personally in my own personal account because I like to keep everything on one app for my public YouTube investing. It's all on M1. M1 doesn't offer it. So unfortunately, I cannot publicly show its performance, but I'll have to make a mental note. And if in future streams, if you remind me, we will review HGBL. Because yes, I will be investing in it personally, just not publicly. So unfortunate. That's why I was saying earlier that I'm thinking about switching to Charles Schwab for my public YouTube portfolio, because this has happened a few times now where the company I've selected is just not available for purchase on M1. Aesthetically, I like M1 a lot, but unfortunate that they do not cover all of the companies I want to invest in. So, I gotta be honest. I can't take credit for this. Like, a company drastically outperforming earnings. I'm not making calls on a company drastically outperforming earnings. What I'm doing is I'm looking at a scenario that I think the company is likely to exceed. I'm looking at a base case, and I'm investing based on that. I'm assuming, hey, if this company is able to just pull off the bare minimum, if they're able to do that, then I want to have solid returns. I want to have returns in excess of the 8.25% that I target. I want to have excess returns if they just do what they're supposed to do, just barely. Now, this is the plus side though. When I invest in a company that's undervalued for the base case, whenever they exceed, then we see huge returns. That is the nice thing about value investing. But I don't want you to think that, I saw this coming. Certainly I did not. There's a lot of uncertainty with the world of investing. So, okay. But are they still, let's also ask ourselves, is this company still undervalued? Because now their share price is much higher than the analyst targets. Now, these targets were made before the latest information came out. So let's keep that in mind. Okay, so they only have 2 years of revenue growth. Analysts projected about 5% going forward for the next 2 years. Let's see. %, 3%, and we'll say 5%. So and their past revenue growth was 5%. So if they're able to keep trucking along, well, and I haven't even changed, let me also look at their free cash flow margin. Okay. So this is the kicker right here. So what percentage of capital expenditures do I want to give credit to this company? So generally speaking, if I'm just going to throw a number out there, I will use their depreciation as a proxy for their maintenance CapEx, and then everything beyond the depreciation I use as growth CapEx. So let's assume for a minute that I can give this company credit for 35%. That is the CapEx that they spend above their depreciation on average. That would mean that their free cash flow margin over the last 5 years has averaged about 18%, which is much higher than what we gave them credit for here. So if I bump it up to 18, then I'm still seeing massive upsides on Plab. Still seeing massive upsides. Dang it. Let's see. Yeah. This company looks really strong. Still. Is this so what is this saying? So yeah, according to this, I'm saying that my projection could be $68 per share. The share price is currently 37. So yeah, like at first glance, good call. Good call, Okage. Yes, that would render, I see what you're saying. That would affect these projections here. But I'm only looking at the my projection. The my projection is only affected by these. So yes, you're 100% right. You should ignore those. And there wasn't good analyst projections for 5 years. So the average was about 5. That could be our base case. We can do a bull case of 10%. Now these aren't analyst projections. These are Brian projections. And then, what do we want to say for the bear case? -5. Let's do a big spread. Yeah, so even with like losing 5%, they still appear to have a solid upside. So yeah, you're right, Hokage. 84% upside is amazing. So to me, at first glance, now I still have to dig into. I would want to have a deeper look into what their revenue growth could be. But, if we assume 2% going forward. Oh, geez. And I had this in here. That changes things. That free cash flow margin growth changes some things. Let's put it back. Hold on. 5, 3, 5. 64%, still very, very strong. 2, 2, 2. If I assume just 2% revenue growth going forward, still seeing a 19% upside. So yes, I think Plab is good to keep holding for now. I don't plan to sell. Hokage asks, does this pull up the latest earnings? I don't think stock analysis has it yet. Let's see. I don't think it does. If stock analysis doesn't have it, then now I'm confused. Why is this October? Oh, the period ends October. Yeah, it looks like it does have it. Wait, that doesn't seem right. Yeah, and see, this is another example. This company only has 2 analysts, so there's not a ton of people looking at this company. That's the best place to find deep value stocks, is where people are not looking, where there's not as much competition. Yeah, I agree, Hokage. I see what you're saying. Okay, let's see if I can pull it up here. Oh, that's their transcript. Anyway, that's all I have for today. But yes, I would say tentatively that Photronics Inc., Plab, P-L-A-B, would say they do appear to be undervalued. At this time, I do not plan on selling this holding. Let it be the top holding. Let it be. Because people were not looking, that is the reason it went kaboom today. Yes, you're 100% right, Hokage. 100%. All right, man. Well, hey, I appreciate you tuning in as always. It's always a pleasure to go back and forth with you. If you have any companies you want me to look at, let me know. I'm always happy to check them out. Otherwise, I'll be coming in next week with another company to look at. And I never got your opinion on Heritage Global. What did you think about this one? This one, when you see a company like this, are you a little squeamish about it because it's only $1.35? That is scary. And I know you like to dabble in technical analysis. Do you see anything of note? Like, I imagine a 5-year chart wouldn't really give you much information for technical analysis, because since this low, there's been so much new information that's come out. I feel like using it is probably irrelevant, but hey, I don't know. I don't know about technical analysis, so I'll leave that up to you. In any case, this company looks incredibly undervalued. Incredibly. Insanely. HGBO. Let me look at it one more time. What did we say? We said I gave it 12%. If I just give it 12%, and if this company just doesn't blow it, if they just hold on and they don't lose revenue on average, if they're just flat, then there's a 65% upside. 65. Oh, okay. So Hokage says, I can see it go down to 1.2 in the short term, but that depends because it is a small cap. They tend to overreact both ways. Okay, that makes sense. Yeah, I can see that. Right now, to me, it looks like it is overreacting big time to the downside. My goodness. Like this is just so compelling to me. This 0% growth being 65%. And then when I couple that with the CEO's positive remarks about their future, continue to report increased distressed assets. Every indicator says asset flow is on the rise. When asset flow is on the rise, their revenue is on the rise. They just have to be pulling in the deals. Yeah, I mean, this... we could also see investing in this company as a little bit of a hedge for market crash, or a recession. If the economy slows down and we see more assets in distress, Heritage Global maybe performs a little bit better. So maybe a fair hedge as well. Hokage says, no harm in having as a part of a bigger portfolio. Yep, I agree. Definitely not something I'm going to be putting a significant percentage in. This one's pretty uncertain. But yeah, considering they have good cash reserves. Yes, they do. Gosh, here, the one thing about value investing is it removes a lot of risk. 19 million in cash. 4 billion in debt. They've got plenty of cash, and then also ironically enough, if this company had to liquidate, which that's their business, that's what they do. They do a good job. They liquidate businesses basically, and auction them off. I'm assuming if they had to do that, they'd be able to auction off their own balance sheet, total assets, 86 million, even though their share price, 46 million. So kind of like small cap blue chip. Yes, indeed. All right, Hokage, I appreciate you, man. I'm going to head out. Let me know next time if you have any companies you want me to look at. I'm always down. Hope you enjoyed, and have a good night. See you next week.